Hi, Larry Gaines, PowerCycleTrading.com. So last week I did a option video for the Money Show here on how to hedge a stock using a protective collar strategy. Now in this video I'm going to show you how to do a portfolio hedge. So hedging your, it could be an index or equity portfolio on the NASDAQ or the S&P using index options, a protective collar strategy to protect your overall portfolio. So let's take a look at how this can be done. So to hedge a portfolio using index options or options in general, what we want to do is select an index with a high correlation to the portfolio that you want to protect. So we're going to look at either using, if your portfolio is more geared to the S&P 500 with the stocks that it has into it, we'll use the SPX. Or if it's using, say you have a portfolio that's more made up of NASDAQ 100 type stocks, we could use the NDX, or kind of Russell small cap stocks, we could use the RUT. So first you want to look at the portfolio to hedge, and what we're going to do is we're going to hedge by selling index calls and at the same time buying an equal number of index puts. So this will lock in the value of your portfolio to guard against any really major adverse market movements, and this is known as what we call a protective index collar. So this hedging strategy is to finance the purchase of the protective index puts using the premium you collect from selling the index calls. So it's going to protect your downside, but also will cap your upside if the market goes, back up. So we're gonna figure this out by what we use is the number of index options required is done by kind of a formula where we look at the value of your holdings divided by the index level times the contract multiplier. So let's take a look and see how that works out. So in this example, it's going to be based on the S&P 500 and the value on the 14th of September. So let me show you where the market was trading at that point in time. So here's the 14th. So this was based on the examples based on the S&P 500 using the SPX, the index options, or the index SPX. And right here on the 14th, it was trading right here at 33.97. All right, so that's going to be, we're going to use that as the basis to construct the collar to protect your portfolio of primarily S&P type 500 stocks. So in this example, your portfolio is consisting of large cap US stocks that are based on the S&P. And so your value based on that, point in time was $1 million for your portfolio. So to determine the index to use, in this case we're going to use the S&P 500, and then we need to calculate how many puts and call contracts to buy and sell to fully hedge this portfolio, and we're going to use this formula. The number of index options required will be the value of your holding, so $1 million, divided by the index level and times the contract multiplier. So let's go through this multiplier example. So we're going to look to purchase out of the money SPX index puts, and at the same time selling an equal number of slightly out of the money S&P or SPX index calls. And in this example, we're going to go 2 months out to give us plenty of time. So this would be the 20 November option series. So on the 14th, the current level again was 33.97. And then this in this example, we're going to look to buy the November 20 31.30 SPX puts. Okay, that was about a minus 25 delta, and those were costing $68.80 per contract. And then we're going to sell at the same time the 20 November 35.25 call contracts, and that had about a 36 delta, and that was going to receive about $71.30. So the cost of this collar was actually a credit to you of $250 or $250 per option contract. So here's how we're going to figure out how many then to buy. So we're going to go through and we're going to use the multiplier 100. So each SPX contract is equivalent to 100. So you multiply that 68.80 or whatever times 100, and that'll give you the actual value. So number of contracts needed would be this. So we take the portfolio value of $1 million, and then the value at the time when we were valuing this index, this portfolio was the S&P was 33.97, and then times 100. So that would be 1 million value divided by 339,700. So that gives you 2.94, or round it to 3 contracts. So you need to do 3 contracts to protect this portfolio. So total of puts would be 3 needed to be purchased, and you then need to sell 3 calls. So the total cost then would be 3 times your 68.80 for the cost of the puts up here, right here, times 100. So that would be a total cost out of pocket of $20,640. And then the premium collected for the short calls, 3 times 71.30 times 100, so $21,390. So your total premium, net premium on this collar hedge would be $750 to hedge a $1 million portfolio. So on the 14th, here's the portfolio here. So it had gone down that day already towards the end of the day to 33.87. So this hedge was up $800 $898. Now your portfolio would have gone down in value, but this is going to offset that using this hedge of being long the 3130 puts, 3 contracts, short the 3525 calls, 3 contracts, and that's your profit to offset any downside move on your portfolio. And here it is currently today on the 17th. So here's the index collar value today on the 17th. All right, so the current market is trading at 33.42. So this portfolio hedge on 3 contracts is up over $9,000. So you can see the long 3 puts contracts at 31.30 at 68.80. Now those have spiked up to 78.80. The short 35.25 calls that you short at 71.30 has dropped down in value to 50.40. So that makes up that profit. Now again though, your portfolio will go down in value, but this is going to offset that by doing this protective collar. So I hope this helps, and if you'd like to learn more about different types of option strategies, please come join me at powercycletrading.com. Good luck trading.